Alright, so we've already talked about support and resistance trend lines. Now we're going to talk about support and resistance levels. So support levels. Let's imagine a situation where we have a downward trend in the market. And in this case, a support level is a horizontal line, which is called support level, which represents a barrier for the price. So when we'll find out how to look for support levels in a few minutes, but right now let's see what a support level does to the price. So as the price approaches the support level, traders become hesitant because they don't know what will happen. They don't know whether the price will cross it or whether the price will bounce off and move in the opposite direction. So generally you'll notice a kind of consolidation on the market, and then one of the following three things will happen. Either the price will bounce off the support level and go in the opposite direction, or the price might test the support level a little bit, cross it, and then bounce off and go in the opposite direction. Or the price can actually cross the support level and there'll be a massive impulse in the direction of the trend. So now resistance levels. They're very similar, but they're the opposite. They're above the price. So resistance level puts pressure on the price and doesn't and acts as a barrier for the price going upwards. And once again, generally speaking, there's three possible outcomes. Either the price bounces off the resistance level and goes down, or it can test the resistance level and then go down, or it can cross the resistance level and there'll be a strong impulse in the direction of the trend. There are two main types of support and resistance levels, and these are historical and psychological. Let's have a look at the historical type first. So historical levels. Looking at this chart, can you identify any horizontal lines that have been tried and tested by the price more than one time? We can see one of those lines right away. It's this horizontal support line, and the price tested this line over here at first, and then it came back to this line here. And so what can we anticipate from the price's future movement? Well, we can anticipate that if the price does go towards this support line, then something will probably happen over there. So, and that's how you establish support and resistance levels, the historical type. You look at what happened in the past and you see that, oh, wait a second, so the price was hesitant to cross this level previously, or there was some sort of consolidation there in the past. So maybe that same thing or something might happen when the price approaches this level. And more often than not, that's exactly what will happen. There will be some sort of abnormal movement when the price gets to this level, and that's what we take advantage of. The second type is psychological levels. So they're a bit different in the sense that the price is just in a trend, and then we identify a level which is very often round number. So, for example, 1.5000. That is a number that plays with the minds of traders, and because they don't know whether the price is going to bounce off it or cross it. Mathematically speaking, there's nothing special about 1.500. It's no different to 1.650. But at the same time, in a consumer's head, in a normal person's head who walks the streets and lives his life, in his head, his home currency being traded at above 1.5 and below 1.5 are two distinct things. So you might not care whether it's 1.6 or 1.7, but he'll remember if it's 1.55 or if it's 1.45, because that kind of difference sits in your head. Or same thing if it's like 2.0. Like you would know if your home currency or somebody's home currency is trading at $2 per unit of their currency or below or above. So it's kind of a strong level because it's a round number, and traders tend to be hesitant when the price approaches this level because they don't know what will happen, whether the price will go down or up. And same thing as with historical levels, something happens. One of the three things that we discussed normally happens over here. So let's have a look at an example from a real chart. Here I've got the British pound dollar weekly chart, and I just took this out of my terminal, so this is fresh as of today, 4th of February 2015. And as you can see, the British pound dollar currency pair is approaching, or has approached, this blue support line. And guess what it is? It's 1.5000. And let's have a look here closer. So as we discussed, traders don't know what's going to happen, and these kind of round numbers play with their heads. They're anticipating some sort of reaction or action on the market, and generally the price goes into consolidation for a certain period of time. So traders don't know what's going to happen, and here you can see that's exactly what happened. So before the price reached this level, we had 6 weeks in a row we had bearish candles. You see those 6 white candles going down? There were 6 candles in a row, and as soon as the price got to the psychological level, it stopped. We got 2 bullish candles. So the price went in the opposite direction, and that's because it's testing the level. It doesn't know, nobody knows whether it's going to cross it or whether it's going to bounce off. And so now there's like a balance of power of bears and bulls, and sooner or later one of those 3 things will happen, and we'll see a strong movement afterwards. And in this particular case, you can see that the psychological level is also a historical level. And that's quite common with psychological levels, because they tend to be very significant throughout history. So back in January to July 2013, the price tested this psychological level 3 times. And as you can see, it was unable to. And that's when a massive impulse happened, and the price went upwards and reached somewhere around 1.7 American dollars per British pound. So now it's back here at 1.5000, and everybody's waiting to see what will happen. So to sum up, there are 2 main types of support and resistance lines. These are trend lines, which are diagonal, and these are levels, which are horizontal. And there are 2 types of support and resistance levels: historical levels and psychological levels. And all of them act as barriers for the price. And when the price gets to them, it either bounces off, or we see an impulse when the price crosses these levels. Forex Robots. So in MetaTrader 4, Forex Robots are also called expert advisors, and the whole topic that we're talking about in today's tutorial is called algorithmic trading. So what is it? What is algorithmic trading, and what are these Forex robots? So a Forex robot can be envisaged as an actual robot, but in reality, it's a program. It's like a computer program which can work through MetaTrader 4. Some programs work without MetaTrader 4. And the concept behind it is that if you launch this program on a Forex chart, it's supposed to bring you profits automatically. So you basically just set some inputs for the program, and you let it run, and it'll just earn you money in the background. So let's talk about this for a second. A lot of traders think this is a hoax, this is not possible, this is, the dream of any investor, that you just do nothing and the money is earned in the background. And to some extent, it is true. It's not entirely possible to just have money coming into your trading account all the time with no effort at all. And there are a lot of scams out there on the market, just in the internet, that will tell you buy this Forex robot and it'll earn you money and you'll be rich and you'll never have to worry about trading again. So 90% or 95% of the stuff you see on the internet are scams. They're just trying to get your money as quickly as possible before their system starts to fail. But the truth is that algorithmic trading is actually possible, and it does work. And I'm a live example of that. I'm a live example of a success that I've had in algorithmic trading. Most of my trading, like people sometimes ask me, like, what strategies do you use, and like how often do you trade and things like that. But most of my trading strategies are actually all have all been converted into Forex robots. And I have made tens of thousands of dollars just using Forex Robots, and actually I try to stay away from manual trading because of the convenience that trading with Forex Robots brings, which we'll talk about in a minute. But I just wanted to emphasize that trading with robots is possible. It does bring you money, and it has massive advantages when you're actually into it, when you know what you're doing. It's not effortless. It's not just switch it on and go away. It does require maintenance. It requires certain inputs from the trader, certain decisions, which robots to put on, which ones to take off, and re-optimization and things like that. But the bottom line is it's possible and it's highly advantageous. So some of the advantages that algorithmic trading brings to you as opposed to or when compared to manual trading, well, the first one, of course, is you get the freedom of time. Like the Forex market does give you financial freedom in terms of if you master it, you won't have to go to work anymore and you can trade from any place on the planet. But it doesn't give you freedom of time. You still have to follow your trading strategy. You still have to watch the charts. You still, even at least a couple of hours a day, you will have to sit in front of your computer and make decisions. Whereas when you turn your trading strategy into a Forex robot, you can set it on your chart and just let it run in the background while you sleep, while you have fun with friends and family. And you just have to check up on it once a week or, several times a week. But generally, it frees up the constraints that you may experience when your trading strategy requires you to be in front of the computer. And for me, that's a massive advantage. And I even took it to the next level through setting up a virtual private server where my Forex robots run. So I don't even have to use my home computer. So it's just sitting somewhere in a different country and the Forex robots are running, and I can just check on it once every couple of weeks even and see that everything's going all right. The second massive advantage of algorithmic trading, which can for some people be even more important than the first one, is the psychological side of things. That when you're trading with your own hands and with your own mindset, you have to make certain decisions and you have to watch the market and see your profits and losses, and that can be can have a massive toll on your emotional state, and it can devastate you when you see a loss, or it can even being happy about a profit. You see, that's a good thing. Maybe you might think it is, but in reality, it's not. Forex should be cold-blooded. Ideally, it shouldn't be happy about profits, because if you're happy about profits, you're going to be devastated when you see losses. Everything should be calculated, and you'll see that in our section on live real trading, that our risks will be very diligently calculated, and we will know exactly how much we are risking to lose and things like that, so that when the time comes to open a trade, you're not emotionally involved, and that's very important with Forex trading. So what Forex robots allow you to do is they take out the emotional side of things completely. Because it's a robot trading for you, and because you don't even look at the market, all you're relying on is that your trading strategy is correct. You've come up with a good trading strategy, and it's just going to bring you money in the long run. So even if you have 5 profits and 1 loss, then you're generally making more money than you're losing. Then you'll have profits, so you don't have to worry about the losses and be happy about the profitable trades individually. You just look at the big picture when you have a Forex robot. So those are the 2 main game-changing advantages that Forex robots bring. It's not to say that manual trading is not a great option, is not something that you want to pursue. Definitely, you have to start with manual trading, and some people just stay manual traders because they get passionate about it and they love what they're doing and they genuinely enjoy trading the charts. However, just keep in mind that there is this option of trading with Forex robots, and maybe you might want to check it out at some point through your Forex trading journey. And if you do want to check it out, please have a look at my course. It's the blue one. It's with the sun on the left, and it's called Forex Robots. Let's talk about channels for a minute. Here we've got an upward trend, and as we discussed previously, we can draw a support line which represents a diagonal which is kind of guiding the price, and the price keeps bouncing off it in its journey to the top. Now, what we're going to do is we're going to take this diagonal and we're going to copy it and we're going to put it above the price. So there it is. It's got the same angle as the first one, and it's sitting on one of the highs of the price. So once again, as you can see here, the price is also bouncing off this diagonal as well, and bouncing downwards. The price is kind of moving in a channel or corridor. Now, what are we anticipating from the price going forward? Well, right now we are probably expecting for the price to bounce off the top border and then to go back up. This is where we would enter into a buy order. So once the price has bounced off, we would wait for it to hit this bottom border of the channel. We would enter into a buy order, and if the price goes in our direction, once it hits the top border again, that's when we would close our trade. So it's important to note here that in an upward channel, it is recommended to trade only buy orders. And why is that? Well, let's take a few steps back for a second. At this stage, we're anticipating for the price to go down. So we could technically conduct a sell order, but it's not advisable for two reasons. First of all, we'd be trading against the trend, and that's something we said we shouldn't do. We should always trade with the trend. And second, as you can see here, the downward movement is actually smaller than the upward movement. So in an upward channel, if you create sell orders, you will always earn less than if you create buy orders. So that's another reason why in an upward channel you should only trade buy orders. Next, we're going to look at a downward channel. So here we've got a downward trend. We can draw a resistance line. If we copy that line, we can see that very often the price will also follow the copied line. So it won't break through it, will bounce off that line. And channels are very common on the Forex market, and you'll see this from our live trading on a real account further down in this course. So here we're expecting the price to go up, then we'll conduct a sell order, and we'll close our order once the price reaches the opposite side of the channel. So once again, in a downward channel, it is advised to open sell orders, because you would be, in this case, you'll be trading with the trend and you'll get longer movements. And so those are the two main ways of trading channels. It's actually one way, but in two different types of channels. And it's always trading inside the channel. And more often than not, the price does stay in the channel. But sooner or later, of course, the price will break the channel. And that's why there's an alternative strategy where, in this case, instead of opening a sell order, you would open a buy order, and you would expect the price to go somewhere out of the channel. You would use this strategy when your other analysis is telling you that this channel is getting too old and the price is going to break through it. So when the channel is quite new, there's more chances that the price will stay inside. When the channel has been around for a while, the chances of the price breaking out are constantly growing. Both strategies are valid. Depends on the situation and what your other technical analysis tells you. So to sum up with channels, direction, trade with the channel, stay inside the channel. It's more likely that the price will bounce into the channel. There's an alternative strategy, which is a breakthrough strategy, and that is used when you expect the price to break free from the channel.